We are starting with C6.1. First question. A company is evaluating a project that requires initial investment of rupees 60 lakhs in fixed assets and 12 lakhs towards additional working capital. The project is expected to increase annual real cash flow before tax by 24 lakhs. Now try to understand. Normally, if these wordings are written, I will assume that tax benefit on depreciation is already considered. If it is annual real cash inflows before taxes, I will assume that tax benefit on depreciation is taken. But see the wordings: annual real cash flows before taxes. So depreciation tax benefit is not taken. If something like this was written, annual real cash flows after taxes, I can assume tax benefit on depreciation is taken. But if it is written it is before taxes, that means tax benefit on depreciation is not taken. We will have to take it separately. During its life, the fixed asset would have zero residual value at the end of the 5 years. The company follows the straight line method of depreciation for tax purposes. Also, inflation is expected to be 6% per year. For evaluating the project, company uses discount rate of 12% in real terms. Company's tax rate is 30%. This is the reason why we have taken this question over here. Advice: whether the company should accept the project by calculating NPV in real terms, take present value of cash flow up to 3 places after decimals. First, let me solve that capital budgeting questions of cash flows. I need to find out cash flows from 1 to 5 years. My cash flows before tax is the 24 lakhs. I am directly finding out cash flow after tax. Sir, what about depreciation? I will be treating depreciation separately. 24 lakhs cash flow after tax. Company's tax rate is 30%. So 24 lakhs into 70%. 16.8 lakhs. This is cash flow after tax. I have done 24 into 0.70. 1 minus t. Now I will be considering tax benefit on depreciation. 2 methods to find out cash flow. First, ignore the depreciation and just add tax benefit on depreciation. I'll be getting my cash flow. We have learned it in capital budgeting. What is first? Depreciation will be 60 lakhs divided by 5. That will be 12 lakhs multiplied by tax benefit is multiplied by t. After tax is 1 minus t, tax benefit is multiplied by t. So it is the 3.6 lakhs. Adding this to, I will be getting cash flows for 1 to 5 years. It is 16.8 plus 3.6. 20.4 lakhs. 20 lakhs 40,000. So what will be my cash flow? For 1 to 5 years, my cash flows would be 20 lakh 40,000. At the end of 5th year, I will be getting zero scrap value. Let me work. There is also working capital, right? Initial investment of 60 lakhs is required. So I'm finding out cash outflows at the end of 0 year. There will be 60 lakhs of cash outflows. 12 lakhs towards additional working capital. Working capital is a cash outflow at the end of 0 year. It is a cash inflow at the end of a 5th year. It will be cash outflow at the end of 0 year, cash inflow at the end of last year. This we have learned in capital budgeting. This is working capital, right? Will be cash outflow at the end of 0 year, cash inflow at the end of first year. And those are my cash flows. I need to find out present value of cash inflow. Now, here there is a problem. There are 2 or 3 rates which are given. Inflation is expected to be 6%. For evaluating similar project, company uses discounting rate of 12% in real terms. So my discounted rate of return in real terms is 12%. Are this cash flow real cash flow? Yes. Then real cash flow can be discounted with the real rate of return. I'll explain you real and nominal rate of return. But if the cash flows are real, discount rate should be used which is real. If the cash flows are nominal, discount rate should be used which is nominal. Try to concentrate. Now I am finding out present value at the rate of 12% because 12% is the real discount rate and my cash flows are also real cash flows. It will be 1 divided by 1.12 is equal to m plus 2, 3, 4, 5. MRC multiplied by 20.4. It is 73.5374. This 12 lakhs rupees I'll have to find out separately. It is 6.8091. Present value of cash inflow will be 6.8091 plus 73.5374. 80.3465. This is my cash outflow which is 72. It is at the end of 0 year, so it itself is a present value. Present value of cash outflow is 72 and this will be 3465 and this is 8.3465 lakhs is nothing but my NPV. I should accept the project. Now, so the question was very easy. You said there is something difficult. Try to concentrate. You need to understand nominal rate of return and real rate of return. Try to concentrate. My nominal rate of return is the say 12%. Let me take another figure because it is 12% in this particular question. All right. So I want a nominal rate of return of 15%. If a country is having inflation rate of 5%, see what will happen if I invest 100 rupees today? I will be getting 12 rupees interest. But wherever I go, there will be 5% increase in price. So the things which were available 100 rupees today will be available at 105 rupees after 1 year. So inflation is eating up my 5 rupees out of 12 rupees. So really I am getting only 7 rupees, which is 7% rate of return on 100. So nominally I want, sorry, this is 15 minus 5, right? 15 minus 5 will be 10% rate of return, which I am getting real. So my expected rate of return in nominal terms is 15%, but in real terms is 10%. In real terms is 10%. So this is real rate of return. This is nominal rate of return. What is real rate of return? A rate of return adjusted by inflation. Try to concentrate why people say that you should not deposit in fixed deposit your money. Because if you invest in fixed deposit, you will be getting 6% rate of return before tax. That also. Let us assume you are not liable to pay the tax. But there is an inflation in the country which is 8%. So actually you are losing 2%. If you will invest in fixed deposit, take out the money and go to purchase chocolates, you will be getting less number of chocolates at 106 rupees. Because the price of the chocolate is now not 100, it is 108. So you will not be even getting one piece of chocolate. So this is what is inflation adjusted discount rate. What is inflation adjusted is -2 in this case. You are getting 6%, but inflation is 8%. Then your real rate of return which you are getting is only 2%. Now, whenever you are taking capital budgeting decision, till now, whatever capital budgeting decisions we have taken, they are always on nominal figures, and the required rate of return is also nominal because we don't know inflation of 5, 10, 15 years. So both these figures, cash flow as well as rate of return, were nominal. Our decision will be correct because everything is nominal. Whenever real cash flows are given, you should use real required rate of return. So as simple as this, if it is nominal, if it is real, then cash flows should be used as nominal and required rate of return should be used as nominal. If it is real, cash flows should be used as real and required rate of return should also be used, which is real, and this should be nominal. This cash flows are nominal, this cash flows are real. All right. Sir, if at the end of first year, I am having a nominal cash flow of 100 rupees, try to convert it into real cash flows. I am helping you out. It is very easy to consider it or calculate real cash flows from this. See, in this question, we don't have to do anything. This is our answer. Why it is our answer? Real cash flows is given. Real rate of return is given. That's all. We don't have to see the inflation rate. Real, you can just discount it, take the decision. But suppose nominal cash flows are given and you are told to find out real cash flows. Then how to find out? It is discounting. You need to find out present value. But present value at the rate of inflation. So what is the inflation rate given in this question? Is the 6%. So discount this 100 rupees by 6%. It is 100 divided by 1.06. 94.33. So if you want to remove inflation from this, why you need to remove? Because 100 rupees you are not getting today, you are getting after 1 year. If you are getting after 1 year, the inflation will be there in that 1 year. And if you want to remove that effect of inflation, then these are your real cash flows. Is it all right? See, 100 nominal is always printed on the note, on your notes, right? Money. Real you cannot see. It will not be printed 94.33. But the real value, considering the inflation of this 100 rupees after 1 year, will be 94.33. Is it all right? So how to find out real cash flows from nominal cash flows? So this happens only in CA final. When you go to CA final, there will be nominal cash flows, real cash flows, inflation rate will be given. Means you will have to find out real cash flows and then discount it at a real rate of return. This discount is not over. It is not present value. It is just adjusted in real terms. But in this question, these figures are directly given. Which cash flow they have given? Real cash flows they have given. They have given even real required rate of return. You can end the question. Sir, if at the end of second year, I was having 200 rupees, convert it into real cash flows. Discount 6% by 2 years. So 200 divided by 1.06 is equal to 177.99. This is nominal. This is a 200 rupees note will be having a real value of 177.99 after 2 years if you ignore inflation. This is because of inflation the value of rupee is decreasing. Still you will have to discount at real rate of return. Real and nominal was good point. Although in this question it was a 5 marks question. Also although in this question you just need to understand the cash flows are real, required rate of return is real, inflation rate is useless. Inflation rate can be used to convert your nominal cash flows into real cash flows, right? So this was nothing but C 6.1. If nominal cash flows would have given, this would have been a really interesting question. We are pending with a 6.4 and I think 6.6. So sorry, 6.7. Both are same question. One suggested answer is incorrect. 6.4 is incorrect. 6.7 is the same question, but the suggested answer is correct. So we will be solving C 6.7. Let us do it. C 6.7. Excellent question again. XYZ Limited is presenting all equity financed. You are doing cost of capital and capital structure. It is 100% equity financed. The directors of the company have been evaluating investment in a project which will require 270 lakhs capital expenditure on new machinery. All right, so cash outflow will be 270 lakhs on new machinery. They expect the capital investment to provide an annual cash flow of 42 lakhs indefinitely. Up till infinite point of time, the cash flow will be 42 lakhs, which is net of all tax adjustment. The tax benefit on depreciation, everything is considered. The discount rate which applies to such investment decision is 14% net. The director of the company believes that the current capital structure, now believe me, this is a question of capital structure even. It is a mixed question of capital structure and capital budgeting. The director of the company believes that current capital structure fails to take advantage of tax benefit of debt. Now you have done this in your cost of capital, right? If you find out cost of capital with interest, you do 1 minus T. Because interest will reduce your taxable profit and hence will reduce your tax. But when you write down dividend, either in preference shares or in equity shares, you don't write down 1 minus T because tax benefit does not happen in dividend. You are all equity financed company. So you might not be getting tax benefit on your interest or dividend. All right. The tax benefit is available only on interest of debentures or interest on bank loan. It is not available on preference shares or equity shares. So director feels that you should take this benefit of 1 minus T. And proposes to finance a new project with undated perpetual debt secured on the company's assets. The company intends to issue sufficient debt to cover the cost of capital expenditure and after tax cost of issue. This I'll explain you. The current annual gross rate of interest required by the market on corporated undated debt, similar risk is 10%. The after tax cost of issue are expected to be 10 lakhs. Company's tax rate is 30%. Now tax is already considered in the cash flow of 42 lakhs. You are required to calculate adjusted present value of the investment. Before finding out adjusted present value, I am considering the existing situation. I am all equity financed. What is my cash outflow? 270 lakhs. Cash outflow is 270 lakhs, which is today. What is my cash inflow after all the taxes? Is 42 lakhs. Cash inflows 1 to infinite years will be 42 lakhs. The required rate of return on such investment is 14% net. Required rate of return is 14%. Can you find out present value of cash inflow in this? Present value of cash inflow. Do you know how to find out present value of infinite cash flow without growth? Cash flow of first year divided by rate of interest, right? 42 lakhs divided by 14% is present value of cash inflow. How I have done it? 1, 2, 3 up till infinite. What is my cash flow? 42 lakhs, 42 lakhs, 42 lakhs up till infinite. My value or present value will be cash flow of first year divided by rate of interest. That is what I have done. So 42 lakhs divided by 14%. 42 lakhs divided by 14%. It is 300. Minus present value of cash outflow. 270 lakhs will be is equal to 30 lakhs. This is my present situation. Presently, even if you are an 100% financed company, so you will bring in all the owner's fund in the business. You are having a positive NPV, you should consider this business, and as it is all equity finance, the equity financer would be earning more than 14% rate of return, right? Their expectation will be satisfied. The required rate of return is 14%, and they will be getting, because there is a positive NPV, they will be getting more rate of return. Now try to concentrate. If the same project, they have not yet started the project. If the same project is a debt finance, so how much debentures or debt you will be raising? You will have to raise a 270 lakhs. Yes, because that is the cost of machinery. You will have to purchase the machinery. This is nothing but debt finance, 270 lakhs. But when you will issue this type of debentures in the market, there will be a cost of 10 lakhs rupees. This you need to pay. There will be a cost of 10 lakhs rupees more. So now your cost will become 270 lakhs for machinery and 10 lakhs rupees for issue of debt. So now your cash outflow will increase, will become 280 lakhs. What will happen to your cash inflow? Try to concentrate. Every year, you will be paying interest of how much? If you borrow 280 lakhs at the rate of 10%, you are issuing the debentures at the rate of 10%. So how much benefit you get every year? 280 lakhs multiplied by 10%, and they are perpetual debentures. They will never end. You will just have to pay the interest, never pay the principal back. Irredeemable debentures. 280 lakhs into 10% is 28 lakhs. Will be your interest cost every year. What will be tax benefit on interest? will be 28 lakhs into tax rate 0.30 will be tax benefit on interest. It is 8.4 lakhs. Tax benefit on interest will last for how many years? This interest I will be paying in first year, second year, third year, fourth year, fifth year up till infinite. So tax benefit on interest of 8.4 lakhs will be also up till infinite. Had I borrowed debt for this project, I would be paying 28 lakhs rupees interest every year, and so my tax benefit on this interest is 8.4 lakhs. I am finding out present value of this additional benefit. Now this should be understood in a good manner. It is cash flow of first year 8.4 lakhs, and as everything is by debt, nothing is from equity, everything is from debt. Please understand, you learned this in cost of capital. Equity shareholders' required rate of return is always higher than debenture holders. So only cost of equity is higher than cost of debt. So if the 100% of finance is done by debt, then required rate of return of debenture holders will be only 10%. They are not having a required rate of return of 14%. See what they want, 10%. So their required rate of return is only 10%. So I should discount this cash flow at the rate of 10%. And what is this present value of additional benefit will be 84 lakhs. So what was original NPV if 100% was financed from equity? It is original NPV. Let me take original present value of cash inflow. Original present value of cash inflow will be 300 lakhs plus additional tax benefit on interest 84 lakhs. Not only additional tax benefit, this is present value of additional tax benefit on interest. Tax benefit on interest is only 8.4 lakhs per annum. The present value of all this benefit is nothing but 84 lakhs minus present value of cash outflow. This will be 384 lakhs and present value of cash outflow will be 270 lakhs. No, now it will be 280 lakhs because 10 lakhs rupees has increased. So it will be 280 lakhs. And so my NPV will become 104 lakhs, which will be greater than this. Instead of 30, now it will be 104 lakhs. So an excellent question. All equity financed, my NPV was positive. If I finance it through debt, then my net present value increases by 104 lakhs. Increases to 104 lakhs by 74 lakhs rupees. You will need to see it 2-3 times to understand the concept because it is extremely deep concept. Try to understand. Second is also the same thing. Find out adjusted discount rate. Now, what is your cash outflow if you finance it through debt? You need to consider this 10. So it is 280 lakhs. What is required rate of return of owners, that is equity shareholders, is 14%. It is of equity shareholders. I am not saying it is of owner, the person who is evaluating the project. Debenture holders are not evaluating the project. The person who is owner are evaluating the project. They are just evaluating that this project is done through outsiders' money or it should be done by our own money. So I want to find out a new concept, which is adjusted rate of return. Try to concentrate. What does it mean? What income would I generate if my cash outflow is 280 lakhs and the required rate of return of equity shareholders is 14%? Every year, what cash I will be generating, including tax benefit, including everything, what would be my income? Try to concentrate. It will be. So basically, I want to find out the income at which my NPV will be 0. Try to concentrate. So my present value of cash inflow minus present value of cash outflow is NPV. And I want to make it NPV 0. We already know the concept, right? NPV is equal to 0 is the rate what actually project is earning. Present value of cash inflow will be income or cash flows divided by 14%. Income divided by 14% is nothing but present value of cash inflow minus present value of cash outflow is 280 lakhs. So income will be 280 lakhs will go on this side, will become positive, divided by, multiplied by 0.14% or 14%. 14 will go on other side. 280 multiplied by 0.14, 39.2. Sorry, I'm not earning, I'm actually earning 104, right? To 80 lakhs, yes. I will not be taking NPV 0, income at which NPV is 104. Try to concentrate first. I'll explain you it in detail. 104. So my answer will be, this will come over here, income is equal to 104 plus 280 multiplied by 0.14. It is 104 plus 280 multiplied by 0.14. Just a minute, I'm making some mistake. I wanted to make my NPV 0. So I needed to reduce the present value of cash outflow by 104 lakhs, because right now, see, this is 104, right? I want to make this as 0. Present value of cash outflow is 280. Present value of cash inflow is 384. So if I reduce this 384 in such a manner that it becomes 280. No, that is an NPV. I think should not be done with this all manner. And also I have not seen practically anyone doing this. So we are not doing this right now. Try to concentrate. What they are saying is, first you are financed by equity where your required rate of return was 14%. Right. Now you are financed by debt where you need to earn minimum 10% into 1 minus t, right? We have understood cost of debt. If cost of debt is 10% before tax, it will be 7% after tax. So now it depends whether in next project you are going to go for equity. If it is equity, your required rate of return will remain 14%. If it is debt, only debt, your required rate of return will remain 7%. But if say it is in the ratio of 50% equity, 50% debt, then what should be your adjusted rate of return? This is just an assumption. What should be required rate of return? 14 sigma I W 0.50, 7% into 0.50. Sigma I W divided by sigma W will be our overall cost of capital and should become my required rate of return for next project, which is financed 50% by equity and 50% by debt. So it is a 14, but this is 7, this is 3.5. This is a 10.5% will be my required rate of return for next project, which is financed 50% by equity and 50% by debt, and assuming that the next project is having same risk category. So this is a good answer. Normally in practical life also this will be done. This is a weird answer. We can go into detail of it, but it is a weird answer. I have never seen anyone doing it in practical life. So let us just forget this. You will be getting 100% of marks if you follow this. Sorry. The statement should be written perfectly. If you issue 50% of equity and 50% of debt, your required rate of return will be 10.50%. The next question in this is masala bond. So what are masala bonds? Try to concentrate. Masala bonds are the bonds which are issued by Indian companies, say Reliance Limited, and which are denominated in Indian currency, that is rupees, but which are issued outside India. They are not issued in India. If they are issued in India, they are in denomination in rupees, they are Indian bonds and they will be regarded as Indian bonds. An Indian bond denominated in Indian currency issued outside India will be treated as masala bonds. All right. So this is bonds denominated in Indian currency rupees issued outside India will be regarded as masala bond.